continue on here with the second part of this. So remember, what we were talking about are capital assets, sales of capital assets. We talked about the holding period for capital assets, that there's a difference in tax rate depending upon whether the asset was held for more than a year or 1 year or less. So that difference between short and long term. There's a difference between, I don't know if we've talked about whether or not there was a gain or a loss. Did they cover that? I can't even remember. Oh, no, we haven't. They're kind of going out of order here. So it makes a difference whether there is a gain or a loss, because our gains, our capital gains, are going to be taxable. And again, that rate is going to vary depending upon how long we held the asset. Our losses, capital losses, we can offset and we're going to talk about this when we talk about the netting of capital gains and losses. But those capital losses are you can offset up to $3,000 of other income. So capital losses offset other capital gains. So for example, if you have, I'm kind of getting ahead of myself here a little bit, but let's say in the same tax year, 2024, you have a capital gain of $20,000. Maybe you sold a bunch of stock, and altogether they had a gain of that stock had a gain of $20,000. But then you also had a capital loss. Maybe you sold some other stocks and they produced a loss. You get to combine those together. Let's say we had a loss. $10,000 is now your overall capital gain. So you get to offset $10,000 of that $20,000 gain because you had these losses in the same year. So they have to happen in the same tax year, of course, but you can also, if there's a capital loss that exceeds the capital gain, let's say we had capital losses of $25,000. So our total loss is $5,000. That's the amount of loss that we realize there, the $5,000. We can recognize this year up to $3,000 of that. And then the remaining $2,000 gets carried forward to subsequent years. Okay, and then that will offset other gains in years to come. We're going to talk a little bit more about that when we talk about the netting of the capital gains and losses. Also, the type of assets sold matters. So when we talked, and this is where we're going to pick up again, is if it's a 1231 asset. Remember, if it's a 1231 asset, it could be treated like a capital asset, could be treated like a piece of business property. But those 1231 assets, if it's depreciable property and we took some depreciation on it, we've got a special capital gains tax rate that applies to the portion of any gain that is due to depreciation as opposed to the portion that is due to appreciation or increase in value of it. Also, we have a special tax rate for collectibles, which we're going to go through here in a minute. What the tax rate is, whether it's short-term or long-term, depends on what the capital gain tax rate is also going to be dependent on the taxpayer's tax bracket. So remember, we've got 3 brackets for long-term capital gains: 0%, 15%, 20%. That bracket is dependent upon the taxpayer's bracket that they're in for ordinary income as well. The higher that tax bracket is, the higher that capital gains tax rate is. That upper 20% tax bracket, though, doesn't kick in until income is pretty high. And we saw that, I think it was over 500,000 in that area. Also, the amount of gain that we recognize will be dependent on the netting of all capital gains and losses. That's what this is here, combining them all together. Okay, we'll go through that. And we have this qualified small business stock that we don't really talk about in a whole lot of detail, but it has a special tax rate as well if the gain is from the sale of qualified small business stock. So let's pick up where we left off. We talked about this, the fact that, we talked about this section 1250 property where we have to divide out, if we have a capital gain, this is depreciable real property. So this is real estate that we have that can be depreciated. Maybe we didn't depreciate it, but we should have depreciated it. So it doesn't matter even if we didn't depreciate it. If it's depreciable real property, it's considered to be Section 1250 property. And this is where we have that special tax rate for the portion of the gain that's due to depreciation. So again, if we bought, or we had our basis of property was $500,000, and we had depreciation over the years of $300,000. So our adjusted basis is $200,000. And then we end up selling this piece of property for, let's say, $700,000. Well, we have to divide that $700,000. Obviously, our basis is $200,000. To figure out what our gain is, our total gain here is $300,000. I'm sorry, goodness, step ahead of myself. $500,000. So we have to recognize a gain of $500,000 on this property, but this gain is composed of two different sources, right? It's composed of the depreciation that we took. This is going to be our 25% gain. Is the depreciation that we took. So 300,000 goes here. So that remaining 200,000 is going to be our capital gain, and so this will be our long-term capital rates. And the reason for that is because this $300,000, when we got the tax benefit of that depreciation, we got to offset ordinary income. It's assumed here that that ordinary income was at a higher tax rate. But what this means, so that 1250 property, we separate out those two distinct parts of the gain. The part attributable to depreciation, which is taxed at 25%, and then the part that is attributable to appreciation, the increase in value of that property, which is the $200,000. Because it did. Look, you can see what the appreciation was. We bought it for $500,000, or at least what the appreciated value was. We bought it for $500,000. We sold it for $700,000. So it increased in value by $200,000. That's going to be taxed at a different tax rate from the amount of the depreciation that we had taken. Okay? So that's what we're talking about here with this Section 1250 property. Let's look at an example here. We've got Mustafa purchased a building in November 2010 for $200,000. Assumes that $69,655 of depreciation was taken on it. So let's pop these numbers in here. All right, so he bought it for $200,000. Took depreciation of $655? So the adjusted basis in this case is $130,345. All right, he sold it for $190,000. The adjusted basis, so again, this is going to go here. to get to our gain of $59,655. There. $190,000 minus the $130,000, $345. It's going to be a long-term capital gain. All of it is going to be a long-term capital gain subject to the 25% rate, because all of it is attributable to, all of this gain is attributable to the depreciation. So you see, if you were to subtract this, it's going to be a negative amount, or actually, I did that wrong. So because we had $69,655 of depreciation taken, $59,000 is the gain that is recognized or that is realized. All of that is going to be due to depreciation, right? Or all of that gain is due to depreciation. None of it is due to appreciation. And you can tell us because we bought it for $200, we sold it for $190. We actually had a $10,000 loss on it, right? But because we took that depreciation, all of that depreciation that we took is going to be subject to that 25% tax rate. So let's look at a difference. So now if he sold it for $220 instead, so now, and same depreciation of $69,655. So we had, what's our adjusted, 150 is our adjusted basis. Oh, sorry, basis is the same. I got the wrong one up here. So 200, we sold it for 220. So I don't change that. That's still 130. So now this changes to what's total gain is 89. Yeah, because it's $30,000 more. So 89,655. Now we're going to subtract the depreciation taken, which was 69,655. That's going to be the amount of the 25% gain. The other 30,000, 20,000 is going to be a long-term capital gain that is subject to the long-term capital rates of 0, 15, or 20%, depending upon his other income, right? So here's the 25% gain, and then here's the questions about that, how that works. Dividing up between the amount that was depreciated and the amount that it appreciated in value. So if it didn't appreciate in value, then all of it is going to be 25% gain because it's all attributable to the depreciation that had been taken. So there is also a separate 28% capital gains tax rate that applies to collectibles. So this is a gain or a loss from the sale or exchange of a work of art, rug, antique, metal, gem, stamp, coin, or alcoholic beverage held for longer than 1 year. So your expensive wine collection would be included in that, right? It also applies to the 1202 gains, which is that qualified small business stock. So that 28% tax rate applies separately. Qualified small business is anything, any corporation, domestic corporation, aggregate gross assets at all times after 1993 have been less than $50 million. Okay, so most small businesses would qualify like that. So if you're selling the qualified small business stock, whatever gain you have would then be taxed at the 28% tax rate. That's the example here. I don't need to go through that. It's just a flat tax rate. Okay, so we talked about the additional Medicare tax. We are all familiar with the additional Medicare tax. There is actually another additional Medicare tax, but it applies to net investment income. So, and this was a tax that was implemented with Obamacare. It's part of the ACA, Affordable Care Act, called the net investment income tax. It's a 3.8% Medicare surtax. So it's on investment income. And remember, what we learned was Medicare tax is only on earned income. Well, this isn't earned income. So this is something that was completely different, that was added starting in it was passed in 2017. Starting in 2018, they had this 3.8% surtax. If modified adjusted gross income is over $250,000 for married filing jointly and qualifying widow or widower, $200,000 for single and head of household, $125,000 for married filing separately, and you have net investment income for the year. So you have to have both of those. Your adjusted gross income has to be above those amounts, and you have net investment income for the year. Then there's an additional surtax of 3.8% on that additional income. I'm sorry, on that additional, on the net investment income portion of that. But it's only the amount that is over and above those thresholds. So if you have, for example, let's say you're married filing jointly and you have $260,000 of AGI, modified AGI, and you have net investment. No, let me do this. No, that's right. And included in that is net investment income of $20,000. So here's your net investment income. You're going to pay tax. What you're going to do is you'll take the $260 minus the threshold, which for married filing jointly was $250,000. So $10,000. You'll take that $20,000, subtract the $10,000, this here. So you'll have net investment income tax, IIT, on the $10,000, because that's the amount that's over $250,000. Okay, and that's the example here. So single taxpayer net investment income of $40,000, modified adjusted gross income of $180,000 will not be subject to the surtax because their modified AGI does not exceed the threshold of $200,000. So the $40,000 is included in the modified adjusted gross income calculation. So if they had net investment income of $40,000, modified AGI of $210,000, the surtax applies on the amount over the threshold amount. So it only apply over the $200,000. So on the $10,000 that's over $200,000, because they had that much net investment income, that's the base that would be used for calculating the tax. Now, if this person had, let's say, they had net investment income of $5,000, then we're only going to use the $5,000. All of that is over and above the $250,000, but we're not going to tax them on $10,000 because they didn't have $10,000 of net investment income. So it's going to be whichever is less, the amount of net investment income that is over, that pushes them over the threshold, or the amount of net investment income. So whichever is lesser of those two. Let's see. I'm going to pause here.